Today our guest has interviewed legends like Charlie Munger and Ray Dalio, written a bestseller which was translated in more than 20 languages, and has spent 25 years in investigating a big question. What makes someone truly successful? Not only financially, but in terms of wisdom and happiness. Today, we have a chance to hear the answers he found along the journey and learn more about the English journalist and writer, William Green. William, welcome to B3 Convida.
Thank you. I'm thrilled to be here.
So your first time in Brazil?
It is. It's so my head is spinning a little bit. I just arrived yesterday from New York and then London.
Yeah, and I know you probably have a very busy agenda and a lot of people very interested to hearing what you have to say. So if we can start. I don't know, you grew up in London where you were born and raised, and what were your early insights in money, finance? How did you start into this amazing world of investment?
My late father, who passed away 20 years ago, absolutely loved the stock market. And so one of my earliest memories is that I would see him always sitting in our drawing room at home in London with the Financial Times and a glass of Scotch whiskey, just looking at the stock prices. And whenever he and I would go on vacation, he would say, son, let's go out and see if we can find the Financial Times. So it was a great joy for him to look at the prices of the stocks that he owned. But I think in retrospect, I realize now looking back that he really didn't know what he was doing. And I feel slightly like I'm betraying him by saying this, but he was much more of a speculator. I think he enjoyed the excitement of the stock market, and there was a sense of fantasy and escape that he was a barrister and then a judge, but there was a sense of, if I could make lots of money on this, or if this went up tenfold, imagine what it would be like. And so I don't think he really spent the time studying it. So I had this sense growing up that there was something magical in those stock tables, that you could look at the prices and there was a sense of wonder. And he had an older an older relative called Leslie, who I think was a very shrewd value investor who would buy stuff cheap. And so I always knew that there were members of the family who were really shrewd about this. And then he had a younger brother who he didn't get on very well with. And they would go out for dinner once a year, and he would come back and he would say, son, I have a stock that Matthew picked. And so
that famous tip, everybody always has a tip, right?
Exactly. So there was a sense I think I had early on that there was magic here, that there were people who knew what they were doing. But at the same time, I also saw that it was dangerous, because I remember during the great crash in 1973 and 1974, Matthew had refused to sell any of his stocks when the market crashed. And he very rightly held on, but he had to sell his house, which had a beautiful swimming pool and stuff in London. So I knew that there was pain. And my father owned a very beautiful 17th century Flemish painting, and he had to sell it, and it would have been worth hundreds of thousands of dollars later. So I had this very early sense of, here's this amazing game where you can make a fortune, but you can also lose your house and the Flemish 17th century beautiful painting that you cherished.
Yeah, it's great. It makes a difference about learning and studying the subject and learning from the best, and what are the strategies and the ideas that make you successful or not, right? So this is one of the biggest insights.
It makes you realize you've got to take it seriously, that it is a beautiful game. It's a game where if you use your mind, you can make money without getting your hands dirty, without having a boss who tells you what to do, and so there is a tremendous magic to it. And yet at the same time, you have to work at it. You have to understand the principles that I think underlie successful long-term investing.
And as you talked about your father and he having other jobs, and we have a lot of like liberal professionals, doctors, lawyers, they all invest, right? Everybody wants to invest, and they have a little bit of the fun of growing their portfolio and watching the stocks. So this is also a very healthy environment for people to nourish this knowledge. But it's important to know that investing is something that comes with a lot of thoughtfulness and study, and it's very important that you understand what you're doing. So then, if not, you're doing something else, right?
Yeah, and I think I failed to realize that when you bought a stock, you were not just buying a piece of paper or a number on a screen, that you were actually buying a stake in a business. And this is something that Ben Graham, famously, Buffett's teacher, would talk about in The Intelligent Investor, that that you need to understand that you're actually buying a piece of an ongoing concern that has future cash flows and profits. And I don't think I actually made that connection for quite a long time. I think it took me a while to realize, oh, I actually, now I own a couple of funds in addition to index funds. And now I look and I think, wow, I actually own a piece of Amazon and a piece of Meta and a piece of Netflix or a piece of Bank of America. I don't think I realized that. I think it takes a long time actually to internalize, at least if you're a slow learner like me, this concept that you really own a stake in a business. And so what you're looking to do partly as a long-term investor is to buy really superior businesses run by honest, talented, capable people. And then you can just sit and ride this extraordinary business. I mean, I went out for breakfast last week with a great investor, a guy called Nick Sleep, who I write about in my book, who, he closed up his hedge fund. He really only owned 3 stocks. He had Amazon, Costco, and Berkshire, and he had this enormous fortune, hundreds of millions of dollars that he'd made. And he said to me the other day that he wrote to his shareholders and he said, you could keep the same portfolio, the same stocks that I have.
It's pretty easy.
And he said, since he closed the fund a decade ago, the stocks that he's continued to own, those same stocks, they're up another 7-fold. So it's just like finding a great business and then sitting. But temperamentally, that's unbelievably difficult for most of us to do because we want to act. And in most areas of life, acting, being dynamic is very helpful. And yet this is one area of life where sometimes you find a really good business and then you just do nothing. You just sit.
Yeah. Waiting is acting, and it requires conscious decision actually to wait and be patient and ride the wave and be confident. But you're always challenged with a lot of doubts and downsides in the market and the economy and whatever's going in geopolitics. So it's a very tough mental discipline, right? To actually be able to hold for those long periods.
And it goes against our nature. But we love getting dopamine hits, and I think the society that we live in now, we get more and more dopamine hits, right? We're dinged by our phones constantly by notifications, and then news coming at us the whole time, and it's amazing. There's more information than ever, and yet at the same time, I think when I look at a lot of the great investors, part of what they have is this ability to detach themselves from the market and to look at it and use the market. The market is serving them rather than them just constantly reacting to the market. And so I think one of the great things that all of us need to figure out, both in investing and in life, is how to create an almost countercultural lifestyle where you're able to be patient and thoughtful and measured. So you sit there and you wait for a great opportunity. You don't feel like, I've got to act now. And this has been a very important lesson for me because it makes me think that the faster everybody else is running in their lives to do more and act more, the slower I have to be. And yet here I am in a week where, I've flown from New York to London to Sao Paulo and then to Pittsburgh and Washington and back to New York. So I
gotta balance those crazy weeks with the
that's true,
with the easy ones. But
you should do as I say, not as I do.
That's usually the case. But you mentioned about the dopamine and the new generation and the world that we currently live in with a lot of information and insights. And I'd like to connect that with something that you mentioned in the beginning of your book or your career, that when you're a teenager, you started playing with gambling and everything. And now we're seeing like this big hype in sports betting, everything very easy, just a click. And now the game becomes 10 times more interesting. But then you get people that get addicted. But some people say, no, I am investing here. So how do you relate, and what would be the insights for people that are actually looking at something that should be kind of a leisure, but as a form of investment?
Yeah, when I was about 15, I went to Eton, this very famous school where a lot of the British prime ministers, including David Cameron and Boris Johnson, who were there at the same time as me, studied, and Prince William and Prince Harry. And I was supposed to be becoming a great British gentleman, but instead I would sneak out and I would go bet on the horses at a betting shop opposite Windsor Castle where the Queen lived. And at first I made money, and I thought, this is amazing. I'm actually going to get rich without having to do any work. And I got in a fight with my parents on my 16th birthday because they refused to pay for a very expensive subscription to a service that would tell me about, how you rated the horses and the ground they were on and the like. And I thought this was so outrageous. That
so data was expensive all the way back then.
Exactly. And I was just outraged that they were blocking this really obvious path to incredible riches. But I think, after a while I started to lose money, and I realized that I had no edge. I had nothing. I didn't have any extra skill, any extra information, and the taxes are very high on gambling. And so it was just a bad game, and I stopped gambling, and I've never gambled. I don't gamble in casinos. I never bet on sports, anything. But it was an early realization, I think, that you need the odds on your side. It's very important whether you're betting in the casino or you're betting in your poker game or you're betting on the stock market, to ask yourself, do I have any edge? Do I have any advantage here? And one of the greatest investors of all time is a guy called Ed Thorpe, who I write about in my book, who actually was the guy who figured out how to count cards in blackjack, and then figured out
he was the father of the quant fund industry, right?
Exactly.
That's an amazing read, his books.
Exactly.
Beat the Market and Be the Dealer. Those are two amazing books.
Total genius. And he ran a hedge fund that didn't have a losing quarter in 20 years. And I said to him once, how do I know if I have an edge? And he said, well, if you're having to ask that, that's kind of concerning. He said, if you have no rational reason to believe that you have an edge, then you probably don't. And so I think one of the most important things for regular investors to ask themselves is, do I have any reason to believe that I have greater skills, that I have greater technical knowledge of the markets, how to value assets, that I have a better temperament than most people? Do I have better access to information? And for someone like me, I think part of my process of working on this book, Richer, Wiser, Happier, but also on my podcast, is that I realized I'm not them. They have a better temperament than I do. Okay. And they're much more obsessive. They're much more fanatical. And so part of what I ended up doing is saying, okay, I'm going to find 3 or 4 other people that I can invest with who I think have a much better temperament than me. And they tend to be people who are very unemotional, very patient, very calm. There's one guy I had a long lunch with before I invested with him. And most of what we talked about during the lunch was his meditation practice, because I take great comfort in the knowledge that he's calm. I once asked him who he took after, whether it was his mother, who was, I think, a housewife, or his father, who ran a big division in an investment firm. And he said, yeah, my mother. And I said, how come? And he said, she was very chill. And I thought, that's the kind of characteristic I want. I want to invest with someone who's chill, who's calm, who looks at the market very calmly, and then once in a while sees a very mispriced bet and pounces and grabs it with what Charlie Munger called gumption, with courage. And so it's very different than what most people are doing, when most people in the markets, but also in life, are acting the whole time. But then what's complicated and beautiful about the markets is that there are so many ways to win. So I have a friend who I met with last week who's in the masterclass that I've been teaching. I have a group of about 20 students. And when I say students, I'm like the least clever person in the group. And this guy runs a quant fund, and the returns are just stunning. And yet I think his average holding is 15 days, something like that. So there are people like that. But he was a professor of physics at Stanford. I mean, he has a different kind of brain than I have. So he's able to see these disparities, these anomalies in the market so he has an edge that I don't have.
Yeah, and this is an industry and an area where we see a lot of interest in, like, the quant and the short-term trading, a lot of day traders. And it's what I see a big difference between, like, this is not the same thing as gambling, because when you're day trading, you have a market, you have some analysis, you can learn, you can grow, you can find a job at a financial firm. So how do you relate these two things and this growing industry of the quantitative trading?
I have a bias that I have to admit against day trading, because I sort of studied in the church of Buffett and Munger and these guys who are very, very long-term. But there are a lot of ways to climb the mountain. You can make money in very short-term ways. You can make money. I remember having this discussion with Howard Marks, who oversees something like $200 billion at Oaktree. And he said, whenever I have a rule where I say, you can't make money by timing the market, you can't make money by predicting the future, he said, there's always an exception to the rule because there's the human factor. So he said, if you're George Soros, maybe you can time the market. But I think for regular people, we have to be very wary of our capacity for self-delusion. And so it's very, very important, whether you're a day trader or a long-term investor, to say, am I just gambling? Am I just speculating? Or do I have a reason to believe that I know something that other people don't? And so it's possible that I have an edge in terms of picking the type of Munger-style investor who's very patient and just owns maybe 8-10 stocks. That's something that fascinates me, and that I understand the philosophy behind it. I don't have any advantage in terms of day trading, and so I think you just have to be brutally honest with yourself. In a way, investing is like a high-risk sport, like skydiving, and so you pay a heavy price for self-delusion. And so one of the things that I've ended up doing is that because I know that I may be deluding myself into thinking that I can beat the market over the long term when it's very, very difficult to do, I also own a couple of index funds. Okay. And so it's a hedge against my own capacity for lying to myself, for thinking that well, I'm so smart and I have such access to such brilliant people that of course I can pick the winners. And it's like, yeah, but that's a really hard game. And what if they get divorced and become depressed? What if they take on too many assets and it becomes harder to manage their fund? There's so much that can go wrong. What if they argue with their partner in work and they end up leaving the firm? And so I think it's just really important in a way to set yourself up in life so that if you're wrong, you'll be okay. And there's a famous investor, a guy called Jeffrey Gundlach, who's often called the king of bonds, who said to me that he's wrong about a third of the time. And so he said, you have to always ask yourself, what's the consequence if I'm wrong with this bet? And so it's fine if you're an amazing day trader and you can really make money. I have a niece who's done unbelievably trading. I mean, it's just ridiculous how well she's done. If you're really good, that's fantastic. But even with her, I'm constantly saying, please, can you just buy yourself a house? Just take some money out of the market. And just in case you're deluding yourself, get something that's really solid that you get out of your trading success.
From time to time, generate some liquidity, right?
I think so. And I think all of us should put more focus on the importance of survival, the primacy of simply avoiding ruin. And so, yes, we want to make lots of money. Yes, we want financial freedom. But you got to survive. And so I think that also means being very careful about not having too much leverage, not having too much debt, living within your means. And this stuff sounds so boring and mundane that half the people who are listening to us, their eyes will glaze over and they'll say, yeah. But Charlie Munger once said, 3 things ruin people. And I think they were liquor, leverage, and drugs. And so just beware of leverage. Whenever you see someone incredibly smart get in trouble, it's because they did some recklessly foolish thing that we all look at in retrospect and we're like, that was so preventable. It was so avoidable. And it's the same when you think about, driving drunk or texting in your car or, like these little things that are such predictable mistakes. And so a lot of what people like Charlie Munger was doing both in markets and life was just avoiding stupidity, avoiding things that could lead to ruin.
Yeah, and looking in hindsight, it's very easy to find the stupidities. But when you're looking ahead, I know there's this FOMO feeling, like the fear of missing out, where everybody's doing, you're seeing everybody doing great, but you do not believe that. And at the same time, you need to weigh that against the discipline of being patient and all this analysis. And this is very tough from a behavior and from a psychological perspective, right?
It's very important, I think, to have a few simple rules that you don't violate. And so for me, just to say, I'm not going to invest in things I don't understand. And so if that means that I miss out on investing in racy tech stocks or cryptocurrencies. That's fine. I invest with people who I think do understand that. But also trying not to invest in things that are super speculative, that are just going up because they're going up. That kind of momentum is very dangerous. And it's difficult because you feel foolish when, I mean, you can imagine, I think my niece literally turned something like $10,000 into $850,000 in a few months in cryptocurrencies.
My God.
And here am I don't own Bitcoin, I don't own any of these things. I feel kind of foolish. I've spent decades studying this stuff and I'm being outperformed
and she probably tipped you at the beginning, right? Let's go.
Yeah, and Bill Miller, who's one of the greatest investors of all time, was telling me to buy Bitcoin when it was at 8,000, and he's a brilliant man, and I ignored it because I'm looking at it and I'm like, yeah, but it doesn't produce any cash flow. How can I value it? And people like Charlie Munger and Warren Buffett were calling it rat poison squared. Were they right? I don't know. So far, they've been wrong. But I think if I go through my life without investing in super speculative things that I don't understand and that don't have a margin of safety, in the long run, I'll be okay. I'll avoid a lot of great profits, but I'll also avoid a lot of catastrophic losses. And so I think it's about taking measured risk and trying just not to get carried away.
In your book, we're talking about the risks and the losses, and in your book you mentioned about the great financial crisis, 2008, 2009. My son was born. He had a birthday yesterday, and he was born exactly the day that Lehman Brothers went broke. So it was a very interesting time. But you mentioned about you passed through a very difficult time. And how was that for you in terms of the lesson learned and the experience?
It was super intense. It was... at the time, I was the editor of the European, Middle Eastern, and African edition of Time magazine. And so I felt like a very important person. I would go off and I would interview prime ministers and presidents and CEOs of great companies. And I was living in a beautiful area of London in Belgravia in one of those beautiful old white stucco houses that was paid for by Time. And they sent my kids to private school. It was an amazing thing. I felt very important. And then when the financial crisis came, really within a few days after Lehman Brothers going under, Time magazine laid off lots of people, and I was one of the most expensive people. And so suddenly I lose my job in the middle of the financial crisis, and I'm 40 years old, and I have 2 young kids in private school. And at the same time, I invested in a hedge fund that has done very well over the years, and I still own, but that was down 46% that year. Wow. And so it was one of those moments where you think, okay, so my industry may never recover. The journalism world, magazine world was really getting killed. And at the same time, my stock portfolio is getting crushed. And do I continue to pay for my kids to go to fancy private schools? I don't want them to suffer for my failure and my struggle. So it was a very, very stressful time. And so one of the things that I had learned is because I was obsessed with the idea of survival, because I had written about great investors over so many years, I wasn't necessarily trying to push the envelope and optimize in every way financially. So I had absolutely no debt, zero debt. And so as a result, I didn't have to sell anything. I sold no stocks in the middle of the financial crisis. In fact, I bought a little bit, not as much as I should have done, but I bought. And so that idea of simply not pushing the envelope too much. This is something that Howard Marks from Oaktree talked to me about a lot. He said, the question is, are you going to live within your means? Are you going to keep saving? Or are you really going to be aggressive? And he said, you can't be too fearful, because he said at a certain point, risk avoidance becomes return avoidance, right? If you don't take risk, then you're not going to make any money in the market. If you don't take risk in your career, you're not going to have a successful career. But I think one of the things I learned from the great investors is that it's about taking calculated risk. It's about taking thoughtful, measured risk. And so I think that the reason I survived that period, and that I've had, thank God, a very good recovery and rebound in the years since then, is that I wasn't so aggressive that I was forced to be a seller at the bottom of the market. And so when you go through a period like we're talking in at the moment, where everything looks great in so many ways in the US market, in particular where I live, and stocks have just gone up for so long, you just don't want to get complacent. You need always to be aware of the fact that we don't know what the future holds. Howard Marks said to me at one point that when COVID happened, he said, we didn't even know that it could happen. We didn't know that the global economy could be shut down by this virus that came mysteriously out of Wuhan in China, that it would shut down, change the way we worked all over the world. So one of the things that he would say to me is that you can't predict the future, but you need to prepare for the future. You need to prepare for uncertainty. And so that means always just saying, let's say we're at the top of the market now. What if that happens, and if it all were to crash? Would I be okay? Would I be emotionally okay? Would I be in so much debt that I would be totally vulnerable? And so I think that was a great lesson from that period. But at the same time, you don't want to be pessimistic either, because at points of great disruption, there's tremendous opportunity. So part of it is positioning yourself so that when times are really difficult, you're going to be able to act and buy when other people are selling and are pessimistic. And so Sir John Templeton, one of the great investors that I interviewed, would buy at what he called the point of maximum pessimism. And so it's not just about being fearful when everyone else is complacent and ebullient. It's also about being so calm and dispassionate and so financially strong and emotionally strong that when everyone else is reeling and they're panicking, you're able to say, I'm going to buy now.
Yeah, and you're looking at it from a different perspective. So you don't get that there already dead. You have room to grow and be greedy when everybody's fearful, right? So this is the good Buffett motto, and it always pays out. But the difficult thing is, how do you get there and do not die before? And when do you know that's the time to enter?
It's very difficult. Charlie Munger once had a meal with Howard Marks, and at the end of the meal, he stood up and he said to Howard, anyone who thinks this is easy is stupid. Why should it be easy to make a fortune at investing? It requires real understanding of these principles and real temperamental control and discipline. And so there was a period, for example, in 2008, 2009, where Howard Marks and his partner, Bruce Karsh, were investing $500 to $600 million a week for 15 weeks running when Lehman Brothers went under, where everybody else was panicking. Nobody wanted to buy. And it felt like the world was teetering on the brink, and the financial system was really close to melting down.
Yes.
And Howard said to me, look, my clients are not paying for me to be a scaredy cat. They're not paying for me to be frightened and curl up in a corner in fetal position and moan in these moments. And he said, by nature, he's actually someone who worries quite a lot. He's quite fearful naturally. But he said, they're paying me in those moments to understand the situation, to analyze the situation accurately and be bold. Mm-hmm. And so in that moment, he invested a fortune, and he made something like $9 billion in profit by investing in toxic companies, in companies that nobody wanted to go near, in the debt of companies that seemed to be going bankrupt. And so just that ability to be dispassionate and unemotional in evaluating the risks and the opportunities, very, very important. And one of the most valuable things I learned from Howard that's been a great help for me, not only in investing, but in life, is he said to me, you have to accommodate yourself to reality as it is. So he said, you look at the market and you say, well, is everyone taking crazy risks at the moment? Are they too complacent? Are they too euphoric? Are deals getting done that shouldn't get done because there's too much easy money flowing into any company just because everyone's in a hurry to get rich? And he said, if those are the conditions, you want to be very careful. You want to exercise caution. But he said, paradoxically, when the risks seem very extreme and everyone suddenly sees companies going bankrupt and there's a panic and, there are problems geopolitically or politically or economically, he said, actually, paradoxically, it may be that it's a wonderful time to invest because companies become misvalued at those moments, in these moments of disruption. So one of the most important things to know is, are you actually equipped to value assets? So Joel Greenblatt, one of the legendary hedge fund managers, said to me, if basically most investors shouldn't be picking individual stocks at all because they're just not equipped to value a business, to decide whether it's cheap or not. So for me, again, this is one of the things where I just say, I don't really want to sit in my study reading annual reports and analyzing financial statements. It's not really what I'm built to do. But I know people who are built to do that. And so part of it is just to give the money to these strange people that I trust who are very unemotional and honest and are willing to sit very quietly in a room and analyze stocks and wait for what Charlie Munger would call a mispriced gamble. Yes. That's half the battle here.
But again, you mentioned something, and it's really important for everybody to understand the investment of time and the studying and understanding the companies. Because when you read, no, when things are like in a meltdown, when it's crisis, it's the time to enter. Fine, that's right. But where to enter, in which companies to enter? Because at those times, some companies do go bust. So if you just invest at those times without analyzing and investing in any sort of company because you think it's going to be quick and easy, and you're not willing to put up your full in-depth analysis, as you mentioned, you may lose money. So it's not that easy just because it's in a meltdown. That's the time to go. So it's important that people understand that you need to invest time and study to find out who are the good companies that are mispriced. Right, the good companies part is very important, not only the misprice, right?
Exactly, and so I think if I were a young investor, I would be investing a lot of time and energy in going back and going on Berkshire Hathaway's website, Buffett's company, and just reading all of the annual reports, the shareholder letters that he wrote that go back on that website to, I think, 1995, and just get this education on what makes a business good, on why he invests in certain businesses. I would go on Oaktree's website and I would read every single one of Howard Marks's memos where he explains how to think about risk. I would go back and I would read Charlie Munger's book, Poor Charlie's Almanac, that's a collection of his essays. Really make a study of this. And, this is one of those areas where it's kind of like if you wanted to become a surgeon, you would actually go to medical school. You would figure out how the body works. And yet here we are in investing where you're playing against very highly skilled, very highly intelligent people. And in order to win this game, I think it's hugely important to understand what it is you're doing. I think I would also really make an effort to read books by people like Jack Bogle, the founder of Vanguard, which now has $10 trillion in assets under management, so that you could really understand why index funds are so difficult to beat. I mean, Bogle said to me once, the mathematics of investing are eternal. And he said, if you look at the average fund and you deduct their expenses, their trading fees, the fact that many of them are tax inefficient, he said, on average, it's just really obvious that actively managed funds are going to underperform the index. And so that means that you have to kind of assume that you should probably index your money. Howard Marks said to me, most investors should index most of their money. You have to, if you're going to try to beat the market and be an active investor, you have to really look at it and say, what is my advantage here? And I had a conversation with a legendary investor, a guy called Chuck Ackrey, who's had an incredible record over many, many decades. And he said to me, you can't dance with all the ladies. And this was his way of saying, you need an area of specialty where you know so much about this one niche, this one type of business, or this one country, or this one market, that you have an advantage. And so he found a number of companies that have very high return on invested capital. So very strong businesses, and they were very well run by honest, capable people. And then he would buy them at moments where they were out of favor. That's an area where he didn't have to become a great international investor. He didn't have to become a trader. He didn't have to have a view on the market overall. He found one area of specialty. And so I think it's such a beautiful game, and the possibility of making enormous amounts of money, it is true, but you have to take it very seriously.
Yes. Don't expect it to be easy, right?
No, no. And also work very much on your temperament, I think, because there's a lot of stuff that we can't control, right? Like we can't control the direction of the market. We can't control the political system. I mean, both here in Brazil and in the US, these are crazy times politically. Geopolitically, it's a crazy time. We don't have any real knowledge of where it's going to go politically. I don't think Donald Trump knows where he's going to go from day to day or minute to minute. So there's no advantage that we can get trying to predict macroeconomics or geopolitics or politics. So you have to focus on the things that you can control. So one of the things that you can control is being able to value businesses and find good businesses that are durable, that have a competitive advantage, a sustainable moat, as Warren Buffett would call it, and that they're constantly trying to expand that moat. Another thing that you can control is your own behavior. So simply deciding there are certain things I'm not going to do, right? Like I decided at a certain point, when I buy a stock, I'm not allowed to sell it for 5 years. And maybe that's stupid because I'll get caught in stocks that are kind of terrible and I made a big mistake. But it's a way of disciplining myself to say, I'm forcing myself to be long term, or to say to myself, I'm simply not going to trade cryptocurrencies because I don't understand them and they seem very speculative to me. And maybe I'm wrong, and at the moment I look kind of foolish. But in the long run, I think if I control my own behavior, that's something within my capability, within my power, is to control my own fear of missing out, my own greed, my own desire to be in a hurry to get rich. So really focus, I think this is very important for our listeners, is to focus on their own behavior. So to focus on being a continuous learning machine, to use a phrase that Charlie Munger would use. So you're constantly learning, you're constantly increasing your knowledge. To focus on being calm, to focus on being disciplined, and also I think not to get so carried away by the thrill of the game and making money that you lose sight of things in your life that are more important.
Yeah, so it's as much a technical game as it is a mental game, right? So the mental portion is also very important. Now, moving to this subject and about your book, The Richer, Wiser, Happier. The Wiser, Happier portion is a very interesting thing, and it's what makes the book special. That you're not just talking about the market and investment, but how have these very successful market icons lived? Are they actually happy? How do they build happiness? What do they value as happiness? And the wisdom that you got from these conversations.
It's been fascinating to me to watch both how they mess up and become unhappy, and also to watch who is happy among them. And so I'm not saying, oh, look, if you make an enormous amount of money, you're going to be happy. I think actually, on the contrary, I look at many of these very successful people and I see how they've screwed up their lives. And so it's very helpful to look at the ones who've not only made money and built successful businesses, but the ones who are really joyful. And so I've made a big focus on that. And there's a guy, for example, a guy called Arnold Vandenberg, who I end the book on, who's just the most extraordinary guy. He's a guy who grew up on the street that Anne Frank was born on in Amsterdam during the Holocaust. And Arnold is Jewish and was born in 1939. And so he was hidden for the first couple of years of his life behind a fake wall in a house. And then he was smuggled across the country in Holland by a 17-year-old girl who risked her life to save the life of this stranger, this 2-3-year-old boy. Wow. And she hid him in a Christian orphanage where they saved his life. But you know, he grew up in such a terrible way, right? In hiding, without his parents, who were sent to Auschwitz, where they amazingly survived. And he was so full of rage as a young man, you know, towards the Nazis, towards his parents, who were very difficult parents in many ways, towards his first wife, who left him for another man.
Oh, wow.
And I see him now, and he's maybe 86 now, and he's so joyful and so loving and such a beautiful human being. It's totally transformed himself. And so he's become a great role model for me. And part of what I see with Arnold is that he really took control of what I would call his inner landscape. He really focused on transforming his mind. And he said he came and talked to my masterclass group a week or so ago, and he was talking about what he had done. And one of the things that he became obsessed with was things like affirmations and the subconscious mind and self-hypnosis. And so he started to say to himself over and over again, I'm a kind and loving person. I am happy, healthy, wealthy, and wise. And so he really made a point of becoming kind, loving, sharing, decent. And at a certain point, he sort of convinced his subconscious mind that that's what he was. And you see him now just so full of joy because he's sharing with other people, constantly sharing his wisdom. He would do things. He's constantly buying people books as gifts. He has a filing cabinet in his office that he showed me that's just full of letters from people whose lives he's changed. And he said to me, this is my bank account. And so for me, this has been very powerful because I see all of the happiest, very successful investors are ones who in some way are sharing tremendously with other people. They're using their wealth to lift up other people. And so Nick Sleep, this great investor who I had breakfast with last week in London, said to me that after reading the book, he actually started to print out all of the letters from people who say to him that he's changed their life. And he said it's inspired by Arnold. And he said to me, when you make a lot of money, you have to say, and then what? So what? What's it for? And he said, it's got to be for lifting up your fellow human. And he said, hopefully you do it anonymously as well. It's not just for your ego. So everyone says, oh, look how rich you are. And so for me, this has been very helpful. It's helped me to realize that I need to spend more of my time trying to help other people, trying to have better relationships, trying to be kinder, trying to be more loving. And so I see Arnold, and I'll tell you just one very brief story about Arnold. He called me a few days before we had this masterclass session, and he spent an hour and a half basically on the phone with me preparing for this session. And at the end, he said to me, thank you so much for spending this time with me today, because it's just so important for me to know that I can leave these people in the group with something that's going to help them. So here he is. He's given an hour and a half of his time, and yet he's thanking me. And it just, so when I look at him and I see him just so joyful at 86, I just think, let me become more like him. Like that's the actual goal. And he just celebrated his 50th wedding anniversary, and he's very charitable, and he works with his son, who he really loves. And so in a way, it's just refocusing your mind on knowing that the money itself is not that important. What the money does is it gives you a tremendous amount of freedom and independence to live the way that you want. But you have to say to yourself, and then what? Then what's it for? And it's got to help you lift up other people, I think, and serve other people in some way that brings happiness to other people. Because otherwise there's no flow. It's all just feeding our own ego and our own self-importance, and it just doesn't work.
Yeah, it gets endless, right? It enters into the cycle where you always want more, and I think it's also important, and a lot of them mention like family and being with your kids and having time for yourself, having time to go quiet and study, so that you can have both the peace of mind to be a better investor, but also not to be trapped into this not altruistic thing, like the selfish things of just looking at the business and at the market, right?
Yeah, and don't worship the money. I think what a lot of us do is we assume that if one day we make enough money, we'll be okay. And I think that's a delusion. I mean, I found as I've, thank God, since that period during the financial crisis, my finances got much, much better. And I definitely see less fear, less anxiety. I love the fact that I was able to pay for my kids to go to good colleges and not take on debt and not saddle them with debt. That's a beautiful thing. I love the fact that I can give some money away and not worry too much about it, and that I can stay in really nice hotels and the like. Yes. That stuff is important. I don't undervalue money, but in many ways, the thing that I've got out of having more money, and I'm not by any means vastly rich, but the thing that I've got is an ability to live in a way that's aligned with who I am. And that's something that I learned from the great investors. I would see that they constructed lives that were true to who they are. And sometimes who they are is pretty crazy. So, I mean, there was a guy who called Irving Kahn, who passed away at the age of 109. I interviewed him at 108.
Wow.
And he would still go to his office. He would commute to his office in Manhattan.
At 100 years old?
Long after 100.
Wow.
And finally, his kids said, Dad, you can't take the bus or the subway anymore. And they insisted on him taking a car. Yeah. But for him, a beautiful life was still in his hundreds, serving his clients whose money he managed, solving intellectual puzzles by picking stocks, working with his son and grandson who worked in the office with him, creating a business, building a business. I don't want to be commuting to an office in Manhattan at 108. I don't want to have a boss. I'm a slightly difficult, very independent, slightly subversive person. For me, wealth means working for myself and knowing that I can walk away from clients who I don't like. And so I only work with people I like. That is a form of wealth to me. And so I think you have to really look at yourself and say, what does a really rich and beautiful life look like to me? And that's going to be idiosyncratic for you. So someone like Nick Sleep, who we talked about before, shut down his fund that he ran with this guy, Case Zakaria, when they were 45. So they had something like $3.5 billion under management. They could have made an absolute fortune. They shut down the fund, retired, gave them, and decided that they were going to basically spend the second half of their lives giving the money to charity in ways that would create maximum value to society. And, when I saw Nick the other day, he was about to go off to race in his vintage car. Okay. And, then he was going to Japan to do more car racing. Mm-hmm. So it's not like he's taken a vow of poverty and is wearing a hair shirt and has no joy. But much of what he does nowadays is really involved in philanthropy. And I think that's a really beautiful thing. It's like he's constructed a life where he's hanging out with his wife and 3 daughters. Mm-hmm. He's giving away lots of money, but he does it anonymously. And he invests, but he's sort of invested in such a patient way that he still just sits on Amazon, Costco, and Berkshire. Mm. And this is after decades. Yeah. And so I think he's kind of constructed this beautiful life. And so I took a photo of him last week in his house in London. And he just looks so alive and so joyful and so beaming. And so I think of that image of Nick Sleep, and I think of the image of Arnold Vandenberg the week before speaking on my masterclass, and I just think that's what I'm aiming for, is to have constructed a life where I'm deeply joyful doing the things that I love to do with the people that I love, that I'm able to travel, I'm able to have conversations like this with you, to give a speech tomorrow at this wonderful event here in Sao Paulo. That to me is a form of wealth. And so it's not really about the money. A lot of it is about doing work that you find fulfilling. A lot of it is about helping other people. A lot of it is about your relationships. And so, I don't know, I think my early fantasy that I was just going to make lots of money investing and then somehow I would be happy. I was sort of, I'm still a fool, but I was even more of a fool then.
Yeah. And it's great that you mentioned this concept of philanthropy and giving back. And you coming from a British American cultural and now bringing this a little bit to Brazil. And on our society, this is something that we need to grow as a society in Brazil, more of the giving back portion of the happiness, that it's more than just you and your family. It's the society and how can we evolve as a nation. So sorry for the brief comment, but I needed to get it out.
It's hugely important what you mentioned. It's very, very valuable. And there's a guy I write about in the first chapter of my book, Monish Pabrai, who came from a very poor background in the suburbs of Mumbai, which was then Bombay. And it's a very brilliant guy. And he basically reverse engineered Buffett and Munger and figured out how to invest, how to pick stocks. And he's used this to build a fortune, and he wants eventually to be a billionaire, and I'm pretty sure he will become a billionaire. He's a very gifted man. But along the way, he set up a foundation called Dakshana, which is Sanskrit for gift. And it's very, what he does is he finds these extraordinarily talented young kids from very poor families, and often from castes that are literally defined in India as being untouchables or backward classes. I mean, these very politically incorrect terms for us.
Yeah,
and
but it's a fact. It happens.
Yeah, and he provides them with an education that allows them to take an exam to the Indian Institutes of Technology, which are very exclusive, very difficult to get into. And this launches them into a whole new world where they get jobs at Microsoft and Alphabet and companies like this. And I've seen the joy that Monish gets out of this. And in fact, the highlight of his year is when he goes to visit the scholars from the Dakshana Foundation program. And he'll go to these incredibly poor villages in the middle of nowhere in India, where often, these are families that are living on maybe $100 a month or even less in some cases. And I went to India with him for the start of the book, and his daughter, Monsoon, who's now a hedge fund manager as well, came with us. And she said to me at one point, she had got a tattoo that was the Dakshana Foundation symbol. Oh, okay. And she said, I don't have a tattoo of the Pabrai Fund's symbol. She's like, the thing that really made her incredibly proud as Monish's daughter was the fact that they were lifting thousands of people out of poverty. And so what's interesting about Monish, in a way, is that he just regards himself as a game player. He's not very pious or sanctimonious or righteous about what he does. He really just thinks, I'm just a really good game player. And yet he's figured out that his life is going to be better if he's using his ability to make money to lift up other people. And so I like that because the great investors are such pragmatists. I often think of them as these practical philosophers. And so when you look at them and you see that being charitable and lifting up others makes them happier, it's a way of me saying, okay, I'm not just going to be charitable because it's the right thing or because God is going to reward me.
Or because the rest of the society is going to see how good I'm doing. It's because I like it and I feel good about it, right?
And I know it's going to make me joyful. And so one of the things that Charlie Munger said is I observe what works and doesn't work and why. And what's distinctive about the great investors is they're these great pragmatists, just observing what works and doesn't work and why. Yeah. And what works is using your own talent, your own money, your own success to lift up other people. And what doesn't work is just being so self-obsessed that it all just continues to be about getting more respect, more honor, better titles, more money. And that's had a huge impact on me, I think, to see that, because I was a very ambitious young man. I went to Eton, I went to Oxford, yes. I went to Columbia, and my dad was a judge, and my brother's a very successful lawyer in England, and so I had this sense of like, if I just work hard enough and I'm good enough, people will respect me. And it's like, no, that's not really gonna work. Really, it's about the quality of your character and whether you're using your talents to help other people. And that doesn't mean that the money and the position and the success are not important. I think you want to have an impact in the world, but you don't want to worship the wrong gods, you know?
Now go a little bit to the wiser part. And I was watching your TED Talks when preparing for this, and you mentioned a passage from Munger where he say one of the keys to success is do not do idiotic things.
Yeah.
And I thought that was incredible. And so if you can comment on that, I think it will be very interesting.
Yeah, it's hugely important. That's had a profound impact on me, is this idea that a lot of what you want to do in life is focus first on what not to do rather than on what to do. And Munger explained to me that the reason why this is such a powerful strategy is that it's often easier to identify what not to do rather than what to do. And so as an investor, you want to actually study unsuccessful investors or successful investors who've blown up and done stupid things and say, well, what caused that problem? Same when you look at a family that's destroyed itself, when you look at someone with a vast fortune who ends up in prison or ends up losing their business, you look at it and you say, what foolish behavior led to this dreadful outcome? And then, as Charlie would say, don't do that. One of the most valuable things you can do is to say, okay, in any situation, what's the stupid move here? And so you can say, for example, if you're about to get in your car and you've had too many drinks, or you're about to get in your oh, you're going to cheat on your taxes, or you're going to cheat on your expenses, or you're going to cheat on your spouse. Just ask yourself, what's the downside here? And so what you're trying to do is avoid things that have massive downside risk and limited upside potential. And in a way, what's beautiful about this is that you're inverting what works in investing, right? So when you look at the great investors, whether they're traders or whether they're long-term investors, you're always looking for asymmetric bets where there's limited downside and tremendous upside, right? Where you can't lose too much, but you can gain a great deal. So if you invert that, what you're looking to avoid, both in investing and life, are situations where there's massive downside and limited upside. So you think about someone like Tom Gaynor, for example, the CEO of Markel, who I write about in the book. He said to me, I would apply Munger's approach of inversion when I'm traveling. He said, I've been with the same woman since I was 15 years old, and I love her dearly. We've been married since we were, 18, 19, 20, very young. And he said, if I go to a bar and I have 2 drinks, I'm not at risk in the way that I am if I have 10 drinks. And so it's just going through life saying, what could really get me in trouble here and let me not do that? And you think about it investing too, and you just think, well, let me not overreach. Let me not borrow money that and then invest it in ways that could get me in huge trouble. And so part of what I'm doing when I say I don't invest in cryptocurrencies, or I don't invest in stocks that I don't understand, or I don't invest borrowed money, is really applying that Munger strategy. And it doesn't mean I'm right in those individual cases. Maybe Bitcoin will go to the moon, and it's eminently possible. It's not that I understand this stuff, and I'm saying it's necessarily terrible. But I need to go through my life really consciously reducing situations where I'm investing in things that I don't understand and that don't seem to have a margin of safety. If you can consistently not do stupid things, you're less likely to blow up. And think about it with marriage as well. I mean, I've been married to the same lovely woman, Lauren, for 33 years, and I'm by no means an ideal husband, as she would definitely tell you. But I really have to think about, when I look, for example, at the great investors, and I realize how many of them got divorced. This is one of the things that Charlie Munger said to me when he read the book. He actually recorded a video for Monish Pabrai, where Monish said to him, how is the book? And he said, great book. And he said, were there any particularly interesting insights? And he said, yeah, how many of us got divorced? And he said, it totally made sense because we all became so absorbed in our work that we neglected our spouses. And so I look at that and I think, okay, I'm really obsessive about my work. So I better be really careful because I don't want to neglect my wife. I don't want to neglect my kids because I know that is a predictable pattern of disaster that leads to divorce.
And you can get rich and miserable at the same time, right?
Exactly. So it's really important to me to spend enough time with my family and to be a decent enough father and husband that I don't go down that road. And when I set up my interview on my podcast with Arnold Vandenberg a week or so ago, he said to me, I can't talk to you on Friday. We'll have to do it on Monday. And I said, how come? And he said, because on my 50th wedding anniversary, I said to my wife, Eileen, I want to give you something special. And she said, well, I'd like you to be with me more. And so he said, I decided then that I wasn't going to work on Fridays. So here's an 86-year-old man deciding that he's not going to work on Fridays because he wants to be able to spend time with his wife of 50 years. And I look at that and I think, okay, that's someone who has structurally changed his life to make sure that he's optimizing for the right things, for a happy wife, for a happy family, for sharing his insights and his financial wealth with other people. And he said to me when I was interviewing him for the book, he said, I'm the richest man alive. And he said, he said, even if I lost all of my money, I would still be rich. And so that's a psychological statement, right? It's like he's got a rich interior life and rich relationships. And so I'm looking at people like that and I'm thinking, how can I reshape my life? How can I structure my life so that I'm not optimizing for the wrong thing.
And define clear priorities, right? Family, and then money or work. This makes the balance a little bit easier.
And friendship is a hugely important thing that I think a lot of us very driven people neglect. You know, I always spent a lot of time with my family. I spent a lot of time with work, and as a result, I neglected my friends. And you know, I think it's difficult because, you know, excellence requires some degree of sacrifice. You do have to be pretty fanatically driven and hardworking to succeed in competitive professions, whether it's writing books or being a journalist or being an investor or running a business, whatever. I mean, it's a competitive world out there. And so there's a real dynamic tension there where you have to work very hard, but you also have to be aware of what you're willing to sacrifice and what you're not willing to sacrifice. There's a woman called Sarah Ketterer that I interviewed many years ago, who I don't think I wrote about her in the book, but she's a remarkable person who was managing over $50 billion, very successful firm. And I asked her about this question of balance, and she said, I've totally sacrificed my friends. And she had, I think, 4 children at the time, was running a big business and with many employees. And she said, you know, I get up very early and I exercise, and I take care of my family, and I run my business. And she said, I just don't, you know, beyond taking care of my health and my family and my business, I don't have the bandwidth. And so I don't think these questions are easy, but I think for all of the people listening, like just to really be self-aware in thinking about what it is you're prepared to sacrifice. And it should be a conscious decision. It shouldn't be, oh, I'm so busy trying to impress impress my peers or impress my bosses or whatever that I don't even think about my health or something. And for me, this is very easy. It's something that I'm very quick to sacrifice exercise. And it's stupid. It's foolish, because if I'm not healthy, God forbid, then nothing becomes possible. And so I just think it's important to be self-aware and ask these questions about what the different aspects of a really happy and abundant life are. And it's very clear that it's not just about professional success and money, but those things are not unimportant either. I mean, my life has been much richer and more fun and more joyful because I get to do things like come to Sao Paulo and see the place and speak to you and give a speech tomorrow. That is part of a rich life for me. But I'm also very conscious of the fact that I'm away for a couple of weeks from my wife and kids.
Yeah. Well, William, this has been an amazing conversation. Lots of insights, both on investment and in life. So thank you very much for your time, for dedicating this to us, to our listeners.
It's been a total joy. Thank you. It's been really lovely. I've very much enjoyed chatting with you.
Thank you.